Welcome to Capital Allocation Lab, the dedicated space for teaching disciplined, long-term investing through calm, clear lessons. If you value timeless ideas and, structure over chasing the market's latest hot takes, you are exactly where you need to be.
And we are dedicated to extracting the kind of deep insight that you can actually implement immediately. We are building something durable today. Please subscribe and like to support more educational episodes. It really helps us keep these lessons free. Today, we're not talking about momentary trends. We are performing a deep dive into building a complete defensive investing policy, one designed to last you decades.
That's right. We call this the Defensive Investor Playbook, and it's really about constructing armor for your portfolio. We have 6 major sections to cover, and we are going deep on each one. So first, we'll start with the psychological cornerstone, understanding what a defensive mindset really means. Then we'll define the simple allocation corridor with a 50-50 anchor. From there, we'll move into the essential mechanics, a practical rebalancing routine. We then break down the components themselves, how to choose high-quality bonds, and the 4 rules for selecting defensive stocks.
Right, the actual building blocks.
Exactly. Finally, we discuss the role of dollar-cost averaging and, perhaps most crucially, defining risk not as volatility, but as permanent impairment of capital.
And our mission here, really, is to take these classic rules-based principles and give you the clarity you need. Clarity to, set up this entire policy this weekend, moving from abstract theory to concrete automated steps. #tag1, what defensive investor really means, mindset.
Okay, let's unpack this concept of the defensive investor. When most people hear defensive, they immediately think, timid, slow, or perhaps afraid of taking market risks. But that is exactly the wrong interpretation here.
Precisely. We define defensive not as timid, but as deliberate. It's proactive, right? Not reactive. The defensive investor has 2 core desires: safety of principal, and perhaps even more valued, freedom from concern. And this freedom, well, it's only achieved if you craft a policy so structurally sound that it operates without you needing to make constant, high-stress judgment calls based on market noise.
So if the goal is safety and freedom from concern, this immediately implies a key mindset shift. And this often contradicts the modern investment ethos that is constantly chasing the next big return. We are told, take more risk for higher return.
That assumption that return is tied directly to the risk you take, it's incomplete. In defensive investing, we believe return is tied more closely to the intelligent effort you put in. And that effort is all about planning and discipline. The defensive strategy is essentially an operating system for your money. You are adopting a rules-based routine specifically to protect yourself from your own worst enemy, your internal impulses when the market is euphoric or, worse, panicked.
I appreciate that emphasis on intelligent effort, because the market will always test your nerves, right? If we look at the core of the playbook, it is all about emphasizing process over prediction. Can we elaborate a bit on why abandoning the prediction game is so critical to safety?
Well, if you try to predict the future, whether stocks will be up 10% or down 20% next quarter, you are guaranteed to fail periodically. It's just inevitable. And those failures will lead to emotionally driven mistakes, often selling low or buying late. It's human nature. Our strategy sidesteps this entirely. We decide in advance exactly how to behave when markets move. That pre-commitment.
The pre-commitment.
Yes, that pre-commitment to a specific action, whether stocks rise or fall, removes the emotional decision from the moment of crisis. That deliberate discipline, that commitment to process, is the ultimate expression of intelligent effort. It's about controlling what you can control, which is your own behavior. #tag2, the allocation corridor, and the 50-50 anchor. So, with that mindset established, let's look at the structure that enables it. The defensive investor builds wealth using 2 and only 2 core components: high-grade bonds and high-grade common stocks. Everything else, unless specifically warranted for a very particular reason, just complicates the mechanism unnecessarily.
Right, keeping it simple. And to control the wild swings inherent in equity markets, we introduced the concept of the investment corridor. This is your guardrail system, you could say, designed to control both exposure and emotion. We set the boundaries strictly. You should have never less than 25% and never more than 75% in stocks, with your bond position always representing the inverse, of course.
Exactly. That 25% minimum equity exposure ensures you participate in long-term economic growth. You're not completely out of the market. But the 75% maximum prevents you from being completely wiped out if a major correction occurs, especially later in life when you have less time to recover. But the crucial decision, the real linchpin here, is where you anchor yourself within that 50-point range.
And we recommend anchoring at the simplest, most neutral point,
Yeah.
50-50. Now, this is where I need to push back a bit.
Yeah.
Because a knowledgeable investor might argue, well, historical data often suggests a 60-40 portfolio delivers a better long-term return, right?
Yeah.
Because of the higher equity exposure. So why does the defensive investor playbook stick rigidly to 50-50 as the default? Isn't 50-50 sort of a concession to volatility management over optimization?
That's an excellent necessary question. And the answer is subtle. 50-50 is not chosen because it necessarily delivers the highest mathematical return over 50 years on paper. It is chosen because it neutralizes the what now question and optimizes for psychological freedom and mechanical utility. Think about it. If you anchor at 50-50, you maximize the dry powder benefit. If stocks soar, great, you benefit partially. 50% is invested. But if stocks fall hard, say, down 30%, your bond cushion is maximized at 50%, and it is fully available to buy stocks at those newly attractive prices.
Ah, okay. So a 60-40 approach would give you less buying power just when prices are lowest.
Precisely. A 60-40 approach offers less dry powder when you need it most, psychologically and financially. The 50-50 anchor ensures you have a true, powerful counterweight to volatility. It's built for action, not just theory.
That makes sense. It's prioritizing the ability to execute the process over marginally higher theoretical returns on a spreadsheet.
Yeah.
And that leads directly to the greatest psychological benefit you mentioned. The anchor forces counter-cyclical behavior.
Exactly right. When markets are high, fear of missing out or just plain greed pushes people to add risk. They pile in. When markets are low, panic pushes them to reduce risk. They sell out near the bottom. It's the classic pattern. The 50-50 symmetric anchor forces you to do the opposite mechanically. If stocks hit 55%, the rule says you sell down, selling high. If stocks hit 45%, the rule says you buy up, buying low. It's a mechanism that forces you to be rational without needing heroic levels of willpower to override your internal panic or greed.
So we have the 50-50 anchor established. Now we need the routine to maintain it. This is the rebalancing step. When the market inevitably moves things, say, 5 percentage points off that 50-50, what is the practical rule for restoring equilibrium? How do we actually do it?
We implement the one-eleventh nudge. This is a precise proportional movement designed to be the minimal effective force required to bring you back towards balance. Not a huge swing, just a nudge.
Can you walk us through the mechanics of that fraction? Where does 1/11th come from?
Certainly. Let's start from our baseline, 50% stocks and 50% bonds. Now imagine stocks rise and your position drifts up to 55% of the total portfolio value. You need to reduce that stock position by 5 percentage points to get back to your 50% target.
Right, 55 down to 50.
So 5 points divided by your current stock weight of 55 points, well, that's almost exactly 1/11th, 555.09. So you mechanically sell 1/11th of your current stock position, whatever that dollar amount is, and move those proceeds into bonds. Simple, mechanical.
Okay, got it. And the opposite occurs during a downturn, presumably.
That's right. If the stock market tumbles and your stock position falls to 45% of the portfolio total, you now need to increase that stock position by 5 percentage points. Now, technically, 5 points divided by the current stock weight of 45 points is actually 1/9, 545 euro, 0.11. But we stick to the approximate consistent rule of the nudge. Using 1/11th of the bond fund to buy stocks is a consistent, clean action. It keeps the rule simple. The critical insight here isn't about perfect mathematical precision down to the last cent. The fraction represents the minimal effective trim required to restore balance.
Okay.
It does this without incurring unnecessary transaction costs or creating, undue tax drag from overtrading.
So the goal is not perfection, but mechanical, proportional correction, a gentle push back to center.
Absolutely. It must be mechanical. And the next question is, when do you do this? We recommend using a predictable schedule. For most defensive investors, reviewing and executing the rebalance twice a year, say, every June and December works best. It's frequent enough to prevent massive drift, but infrequent enough to avoid micromanagement and getting caught up in daily noise.
Alternatively, you mentioned threshold bands before.
Yes, that's the other common method. You can use the threshold band system, which basically says rebalance whenever you are 5 percentage points off target, regardless of the calendar date. This is often more mathematically precise in keeping you close to 50-50. But honestly, the scheduled approach twice a year is often better psychologically for sticking to the process. People tend to follow routines better. The core takeaway remains discipline over precision. Pick a method and stick to it.
And the final crucial warning here, connecting back to the mindset piece we started with, this routine must never be allowed to morph into market timing, right?
Exactly. That's the trap. You are not executing a buy because you suddenly think the market bottomed and will rise next week. Nor are you selling because you read some scary headline and fear a drop. You're simply following your own rules that you set when you were calm and rational. The moment you decide to skip the rebalance because, oh, stocks look really good right now, let's let it ride, you have abandoned the defensive playbook entirely. You're back to guessing. Hashtag TAC4, the bond component quality, taxes, term, and call risk.
Okay, let's dedicate some serious time now to the quiet workhorse of this portfolio, the bond sleeve.
Hmm.
This is the half of the portfolio that is designed to be, well, boring, predictable, and reliably available when you need it. We established that the bond component has three critical jobs for the defensive investor. Can you remind us?
Sure. 1. Steadying the portfolio during equity drawdowns, acting as a shock absorber. 2. Providing potentially spendable income, although that's secondary for many. And 3, most importantly for the system we've described, serving as the essential dry powder for rebalancing when stocks go on sale.
Got it. So achieving those three roles requires attention to four specific, often overlooked technical choices. It's not enough to just buy a bond fund, is it?
Definitely not. You need to be deliberate here too.
Let's start with tax status. This is where many investors, frankly, leave significant money on the table simply by placing assets inefficiently between accounts.
It's a huge unforced error sometimes. It's all about comparing after-tax yields. That's the number that matters. If you are in a high tax bracket and are investing in a standard taxable brokerage account, high-quality municipal bonds munis can often offer a superior after-tax yield compared to traditional taxable corporate or treasury bonds. Even if the headline yield looks lower on the muni, the tax exemption makes the effective return higher for you.
Okay, so munis in taxable accounts for high earners.
Generally, yes. Conversely, in tax-deferred or tax-exempt accounts like your 401k or IRA or Roth IRA, the tax advantage of munis is completely wasted. There's no benefit. So you should hold standard taxable bonds, corporates, treasuries in those accounts. Efficient placement is mandatory for optimizing your overall return. Don't give away tax advantages.
Okay, next up, credit quality. Given that the bond sleeve is meant to be the rock, the safety net, I assume the defensive investor avoids chasing yield here.
Absolutely, unequivocally. We strongly favor high-grade debt, investment-grade corporates, treasuries, high-quality munis. The defensive playbook does not tolerate the risk associated with chasing yield by dropping down the credit ladder into lower-rated debt, like high-yield or junk bonds. The higher volatility and, more importantly, the real risk of default in junk bonds fundamentally undermines the purpose of the bond sleeve, which is safety and stability.
What if someone feels really compelled to add some lower quality bonds for a bit more yield?
If, and this is a big if, you feel compelled to hold a small portion of lower quality issues, it absolutely must be handled through highly diversified funds, never individual junk bonds. And that slice must be kept very modest within the total portfolio. Maybe 5% of the bond sleeve, not 5% of the total portfolio. The core remains high grade.
Got it. Third, let's discuss term, which dictates interest rate risk. This is a perpetual debate. Short bonds, intermediate or long term?
It is, and there's no single perfect answer, just trade-offs. Short-term bonds fluctuate less in value when interest rates move up or down, but they pay less income. Pretty stable, low yield. Long-term bonds pay more income, which is attractive, but they swing much more dramatically in price when rates change. You have higher volatility, higher interest rate risk. The best compromise for the defensive investor generally is to stick to intermediate maturities. Think roughly in the 5 to 10 year range.
Or ladder?
Or, even better for managing rate risk smoothly, you can structure a bond ladder. This means you buy a series of individual high-quality bonds that mature at spaced intervals, say one bond maturing every year for the next 10 years. This gives you predictable cash flow as bonds mature, and it naturally reduces interest rate shock because you are regularly reinvesting maturing principal at whatever the current rates are. It smooths out the ride.
Okay, that makes sense. Finally, let's explain call risk thoroughly. This feels like a subtle trap that often catches investors who are relying on that bond income.
It really is a hidden risk. Call risk is fundamentally a conflict of interest built into some bonds. A callable bond allows the issuer, the corporation or municipality that borrowed the money, to pay off the debt early, usually at face value, par, whenever it suits them. And when does it suit them? Almost always when interest rates have fallen significantly since they issued the bond.
Ah, so they can refinance at a lower rate, just like a homeowner.
Exactly. But for you, the investor, it means you're forced to take your principal back and immediately reinvest it in a much lower rate environment. This happens precisely when you most wanted to lock in that original higher yield. It's a loss of yield security. often when you least expect it. So for the defensive investor, we must favor non-callable bonds whenever possible. Or, if looking at callable bonds, specifically look for low coupon issues trading at a discount to par value.
Why low coupon at a discount?
Because the issuer has much less financial incentive to call back a bond early if its coupon rate is already low compared to current market rates, or if they'd have to pay par value for a bond trading well below par. It offers better structural call protection.
And for simplicity itself, where do government-backed options fit in? Things like treasuries or savings bonds.
They are excellent options for the core. Savings bonds and U.S. Treasuries are the simplest choices. They are government-backed, inherently high quality, and very easy to ladder if you buy individual bonds. And if you find yourself primarily concerned about long-term purchasing power erosion from inflation, incorporating a sleeve of inflation-linked bonds like TIPS, Treasury Inflation-Protected Securities in the U.S., into this high-quality bond allocation is a very prudent defensive measure. They adjust based on inflation. Okay, stepping just outside that pure high-grade bond structure for a moment, we must address two areas where defensive investors often get tempted to stray: preferred stock and high-yield debt.
Right, let's start with straight preferred stock. It often seems to offer a higher yield than regular bonds, but doesn't quite behave like common stock either. What's the verdict for a defensive approach?
Yeah, preferreds sit in a kind of gray area. They are often described, perhaps a bit harshly, but often accurately, as the worst of both worlds security for individual investors building a core defensive portfolio. While it pays fixed dividends, sort of like a bond, it stands lower than bonds in the capital structure during bankruptcy. That means it offers less legal protection if the company gets into trouble.
Less safety than a bond, then?
Correct. And crucially, it has less upside potential than the company's common stock if the business does really well. You typically just get your fixed dividend. And like the callable bonds we just discussed, preferred stock is frequently callable by the issuer when it is financially convenient for them, usually when rates have fallen. So for building the two core sleeves of the defensive portfolio, which are pure safety bonds and growth potential, common stock, preferreds are generally less efficient and carry unnecessary structural risks compared to sticking with high-grade bonds and common stocks.
Okay, clear enough. What about the allure of high yield or junk bonds? They promise a larger coupon payment, suggesting maybe higher income potential for that dry powder sleeve, or just better returns overall.
It's tempting, isn't it, that higher coupon looks attractive. But if a defensive investor absolutely feels the need to venture into high-yield territory, the rules have to be rigid, non-negotiable. First, high-yield debt must only be held through a broadly diversified fund, an ETF or mutual fund. This prevents a single company defaulting from sinking a meaningful portion of your capital. You absolutely cannot pick individual junk bonds defensively.
Diversification is key there.
Absolutely. Second, the overall position must remain small. We're talking a minor part of the bond allocation, not the overall portfolio. Remember the primary function of the bond sleeve: safety and dry powder. The defensive bond sleeve is not designed to be a vehicle for gambling on individual credit outcomes or chasing yield. Its main purpose is capital preservation and providing stability against the equity side. Don't compromise that core function. #Tech6. The stock component for selection rules.
All right, we've established the 50-50 anchor and thoroughly defined the safety component, the bond sleeve. Now we turn to the growth engine, the stock component. For the defensive investor, selecting stocks isn't about finding the next, 10-bagger or the hot new thing. It's about methodical filtering for quality and safety. What are the 4 core rules here?
That's exactly right. It's filtering, not fortune telling. Rule 1. Diversify adequately, not excessively. We aim for a manageable and sufficient range of 10 to 30 individual holdings if you're picking stocks yourself.
Okay, 10 to 30. Why 30 is the upper limit? Why not, say, 50 or 100 for even more diversification?
That's a fair question, because diversification beyond about 30 companies often leads to what Peter Lynch famously called diversification. You start to dilute the impact of your best investment ideas too much. And perhaps more practically, you significantly increase your cognitive load, your ability to stay truly informed about the fundamentals, the business, the valuation of each company you own. It becomes overwhelming. You are seeking adequate diversification to protect against single business risk, like one company having a major unforeseen problem. You're not trying to perfectly replicate the entire market index with individual stocks. Of course, for many, using broad index funds provides instant, complete diversification and is a perfectly acceptable, often preferable, one-fund solution for the entire stock sleeve. Much simpler.
Makes sense. Rule 2.
Rule 2. Look for large, prominent, conservatively financed businesses. We want established sector leaders with balance sheets that can withstand significant economic shock. Think durable. And we need to be specific on what conservatively financed really means. You should look for meaningful common equity relative to total capitalization on the balance sheet. This indicates the business relies less on debt and more on owner's capital. We also want moderate leverage ratios and clear, consistent interest coverage, meaning the company comfortably generates enough operating earnings to pay the interest on its debts year after year.
Okay, strong financials. Rule 3 involves dividends, right?
Yes, Rule 3, a focus on a long dividend record. This is a really powerful filter for durability and quality. We seek a decade or more of uninterrupted dividends, not necessarily growing every year, but uninterrupted. Now, this isn't because dividends themselves are some kind of magic income source. They are powerful, tangible evidence of consistent profitability and strong stewardship by management through various economic cycles. A company that has managed to maintain its dividend through past recessions and market panics has proven something important about its resilience and cash-generating ability.
Got it. Dividends is proof, not magic. And Rule 4, price discipline. This is probably the most difficult rule for many people to enforce, especially when markets are hot and feel euphoric.
It is absolutely vital and, yes, psychologically the hardest. Even the highest quality company in the world can be a terrible investment if you overpay for its stock. The goal of the defensive investor here is to protect principal by ensuring that the valuation you pay provides some margin of safety, some cushion against unforeseen problems or just, being wrong about the future. We use simple, time-tested guardrails for this. Buy individual stocks at no more than approximately 20 times trailing earnings, last year's earnings, or perhaps a bit more robustly, no more than approximately 25 times multi-year average earnings, smoothing out maybe the last 5-7 years of earnings.
Okay, here's the challenge, though. In many market environments, including potentially today, finding a quality, large, prominent business trading at or below 20x trailing earnings feels, well, almost impossible sometimes. What should the defensive investor do if their entire watch list of quality companies violates this price discipline rule? Do they just give up?
No, they don't give up. The answer connects directly back to Section 1, the mindset. You follow the process. You stick to your rules. If nothing meets both the quality criteria and the price discipline criteria, you wait. Period. Price discipline means sometimes having the discipline to do absolutely nothing with the new capital designated for equities. You keep it in the high-grade bonds, which are still serving their purpose as stable dry powder. It is far better to have capital preserved and ready than to rush into an overpriced security simply because you felt the internal pressure to deploy cash immediately. Waiting is an active decision here.
That takes discipline. And if the investor opts for funds instead of individual stocks, how do these rules apply?
If you use funds, the rules become much simpler, which is part of their appeal. Look for broad, low-cost vehicles. A single total market index fund, like one tracking the entire U.S. market or a global index, is a perfect one-fund solution for the equity sleeve. Or, if you want a bit more control over international exposure, you could use a combination of domestic, like an S&P 500 or total U.S. market fund, and international developed market index funds, maybe a 70-30 or 80-20 split between them. Using broad index funds implicitly enforces diversification and ensures you're buying the market at roughly its average valuation, providing a form of modest, built-in price discipline across the entire market spectrum. Now we need to discuss the mechanism for actually funding this portfolio over time, and that's where dollar cost averaging, or DCI, comes in. This simply means investing a fixed dollar amount at set intervals, say $500 every month or $200 every 2 weeks, regardless of where stock or bond prices are at that moment.
It seems almost too basic, too simple, but the psychological mechanism behind it is quite elegant, isn't it?
It really is. Its power lies in its simplicity and its effect on behavior. Think about how it works mechanically. When prices fall, your fixed dollar amount automatically buys more shares or fund units. This naturally lowers your average cost basis over time. When prices rise, that same fixed dollar amount buys fewer shares. The beauty of DCA is not just mathematical, though that helps. It's primarily behavioral. It automates the investment decision.
So what are the two core benefits that make this pretty much a required element of the defensive policy we're building?
Okay, benefit number 1. It absolutely eliminates the paralyzing when question. Should I invest now? Is the market too high? Should I wait for a dip? DCA just sidesteps all that anxiety. You remove the temptation to hoard cash, hoping for a crash, a market timing strategy that is notoriously difficult and often fails because people wait too long or miss the recovery. Benefit number 2. It creates essential emotional insulation. Because the decision is automated, you don't need to predict the market or even feel comfortable about investing each month. You just execute the predetermined plan. You are never fully all in right at a market top, nor are you fully all out missing a recovery. It's smooth as your entry points over time.
So the winning combination then for the defensive investor putting this all together is combining this funding strategy DCA with the rebalancing schedule we talked about earlier.
Precisely. That's the operational engine. You DCA new money into the 50/50 anchor. Practically, this means you always automatically send your new contributions, that fixed monthly amount, to whichever sleeve, stocks or bonds, is currently underweight relative to your 50% target. So DCA helps maintain the balance too. And then you perform that mechanical semiannual rebalancing, the one-eleventh nudge, to make any larger adjustments needed to maintain the target weight. What if your income fluctuates, you ask? Maybe you're freelance or have variable bonuses.
Yeah, what then?
Automate the floor. Set up a minimum automatic monthly DCA amount that you know you can consistently afford. And then, when your cash flow is stronger, you get a bonus, have a good month, you can make additional lump sum contributions, again directing them to the underweight asset class. The key takeaway is consistency. The regular rhythm of the investment beats intensity trying to make big, perfectly timed moves over the long term.
Okay, this next point feels like possibly the most crucial philosophical distinction in the entire defensive playbook. We really need to challenge the media's constant, almost reflexive equation of volatility with risk. For the defensive investor, what is the true definition of risk? What are we actually trying to defend against?
This is fundamental. The true, deeper risk that we are guarding against is permanent impairment of your capital or its purchasing power. Temporary price volatility, the day-to-day, month-to-month wiggle in market prices, is just the nature of market activity. It's noise, not necessarily danger. Permanent impairment means losing your purchasing power forever, often because of one of three structural failures in your investments or your process.
Can we detail those three specific causes of permanent impairment that this whole policy is designed to defend against?
Absolutely. The first cause is when a core business fundamentally deteriorates and never recovers its earning power. Think of a company disrupted by technology that just fades away. Our stock selection rules, focusing on large, prominent, conservatively financed companies with long dividend records, are designed to minimize this risk.
Okay, business failure risk. What's the second?
The second cause is when a borrower defaults on a loan they simply can't pay you back. This is the primary risk in bonds. Our bond rules, sticking overwhelmingly to high-grade debt, directly protect against this risk of default.
Makes sense. And the third cause? You said it might be the most common.
Yes. The third, and perhaps the most common way investors permanently impair their own capital, is when they overpay for an asset. They pay so much, often caught up in euphoria, that the future returns generated by the underlying asset, the business earnings or bond coupons, can never realistically justify the high entry price they paid. Our price discipline guardrails on the stock side, the PE limits, and our focus on not chasing yield on the bond side are specifically designed to protect against this valuation risk.
So putting it all together, if the portfolio fluctuates in value month to month, maybe even drops significantly in a market downturn, that doesn't automatically mean it is risky in the way we're defining risk here.
No, absolutely not. A sound, rules-based portfolio built with diversified stocks bought using strict valuation guardrails, paired reliably with high-grade bonds, is not inherently risky just because its market price fluctuates. Temporary declines are not a problem to be avoided at all costs. They are a necessary feature, an expected part of equity ownership. You have to accept volatility to get long-term growth potential.
And that feature, the temporary decline, ties directly back to the policy mechanics we just discussed, particularly rebalancing.
It does perfectly. The entire defensive policy exists to convert those inevitable temporary market declines from moments of fear into mechanical rebalancing opportunities. The dry powder sitting patiently in the bond sleeve is deployed systematically to buy more shares of the equity sleeve when prices fall. This turns a moment of potential panic, which could lead to selling low, causing real impairment, into a moment of disciplined process execution. It prevents the market decline from becoming an irreversible emotional mistake. #tag99. A one-page policy you can adopt this weekend.
Okay, we've established the mindset, we've defined the components, stocks and bonds, we've outlined the mechanics, allocation, rebalancing, DCA, and we've redefined risk. Now, let's synthesize all of this into a practical commitment document. We call this the one-page policy. And the idea here is this is not just a list of ideas to be read and then forgotten. It's intended as a personal instruction manual that you write for yourself when you are calm and rational,
Exactly.
designed specifically to govern your actions when the market inevitably gets stressful or terrifying.
That's the key. Synthesis and commitment. Let's talk about the essential architecture of this document, breaking it down into its functional rules that you'd actually write down.
Okay, first, the objective and the allocation must be crystal clear right at the top.
Absolutely. The objective section should state something like long-term growth of purchasing power with primary emphasis on safety of principal and freedom from concern. Define your why. The allocation section must specify the anchor, 50% high-grade bonds, 50% broad equities. And just as importantly, it must explicitly define the rebalancing corridor. Maintain equity exposure between 25% and 75% at all times. This sets the boundaries and the target clearly.
Right. Next, the operational mechanics, the commitment to action. What needs to be written down there?
The policy must mandate specific actions, it should state. Rebalancing will be reviewed twice per year, e.g. June 30th and December 31st, or alternatively, whenever the equity weight drifts 5 percentage points from the 50% target. Pick one method. It must also specify the corrective action clearly. Use the one-eleventh nudge selling approximately 111th of the overweight asset class to restore the 50-50 balance. For example, sell stocks at 55% back towards 50%, or buy stocks using bonds at 45% back towards 50%. The policy dictates the action, removing the need for stressful real-time judgment calls.
Okay, and the specific components, the stocks and bonds themselves, must be defined with quality control in mind.
Yes, be specific about your building blocks. The bond sleeve description must specify high quality, e.g. U.S. Treasuries, investment-grade corporates, high-rated munis, tax-aware placement, aim for intermediate term, or use a ladder, avoid unnecessary call risk, keep any lower quality exposure minimal, and diversified. The equity sleeve description must mandate either a broad, low-cost index fund, example, total stock market or S&P 500 plus international developed, or adherence to the 4 quality rules for individual stocks. 1030 holdings, large, prominent, conservatively financed, long dividend records, and maintain non-negotiable price discipline, e.g. 20 trailing PE or 25 FG PE.
That's very clear. And crucially, the behavioral rules and the asset placement rules need to be documented too.
Definitely. Behaviorally, the policy must include explicit prohibitions, things you commit not to do. Like, no market forecasts will influence decisions. No chasing yield in the bond sleeve. Stick rigidly to the rebalancing schedule. It must also commit to the funding mechanism. Dollar cost average new contributions monthly or biweekly, always directing the new cash automatically to the underweight sleeve to help maintain balance. And finally, the policy must mandate efficient asset placement for tax purposes. Place tax-inefficient assets, like taxable bonds, primarily in tax-deferred accounts, IRA 401k. Use tax-free municipal bonds in taxable accounts only when the after-tax yield is demonstrably superior for your tax bracket.
I think maybe the most important section to actually write down, almost as a personal reminder, is the final review commitment and the definition of risk.
Agreed. That seals the commitment. The policy requires an annual review specifically for major life changes. Did you get a new job, get married, have kids, retirement plans change, liquidity needs shift, things like that. But explicitly not for market changes or economic forecasts. The policy is designed to endure those. And finally, repeat the core defensive definition of risk right there on the page. Definition of risk for this policy is the permanent impairment of capital or purchasing power, not temporary market volatility. This document is your shield against your future, possibly panicked self.
Powerful stuff. Now, if the listener is seeking the absolute simplest, minimum viable portfolio structure to implement this weekend, what are the 2 core building blocks they need?
Keep it super simple. The 2 essential building blocks are Block 1, 50%, an intermediate term, high-grade bond fund, or a simple treasury bond ladder. If you have a high tax bracket and are investing in a taxable account, check if a high-quality municipal bond fund offers a better after-tax yield for you. Block 2, 50%, a broad equity index fund. A total U.S. stock market fund or an S&P 500 fund is perfect for the U.S. portion. You might add a total international stock market fund for global diversification, maybe splitting this 50% equity sleeve 70-30 or 80-20 between U.S. and international. Automate your DCA contributions into these 2 funds, directed to the underweight one. Set those 2 rebalancing dates on your calendar, and you have executed the entire core policy. It can be that straightforward.
Yeah, and for investors who like the core idea, but maybe prefer a slight customization, What mild deviations might be permissible without undermining the fundamental safety of the approach?
Okay, you can incorporate a small sleeve of inflation-linked bonds like TIPS within the bond side if long-term inflation is your primary fear. Still high quality, just different mechanics. On the equity side, maybe you could introduce a modest small-cap value tilt fund to complement the core broad index fund, perhaps 10% of the equity sleeve, if you understand and believe in that factor long-term. But we must stress that any customization should be mild and well understood. The core 50-50 anchor between high-quality bonds and broad-quality equities must remain firmly intact. Don't overcomplicate it. Hashtag tag 10. Practical examples, spoken walkthroughs. Okay, let's make this really tangible with a few quick scenarios. Example A, the market goes up scenario. You start perfectly balanced at 50% stocks, 50% bonds. Due to a strong market rally over 6 months, you check your portfolio on your scheduled rebalance date and your allocation has drifted to 55% stocks, 45% bonds.
Okay, so on my calendar reminder date, I log in, I see the 5-5-45 split. What is the precise action I take according to the policy?
You look at the total value of your stock position. You calculate 1/11th of that amount. You then sell that calculated dollar amount of your stocks or stock fund and immediately use the cash proceeds to buy more of your bond position or bond fund. You're not celebrating the gains excessively, nor are you predicting further upside. You are simply restoring the balance back towards 50-50. You acted by rule, neutralizing the natural temptation to just let the winning stock position ride higher and higher, increasing your risk exposure unknowingly.
Got it. Okay, example B. The market goes down scenario,
Yeah.
a major correction hits the stock market, things feel scary, you check your portfolio, and now your mix is 45% stocks, 55% bonds. Panic might be setting in. This is the moment the policy proves its worth, assuming you follow it. This is when the dry powder function of the bonds comes into play. You look at the total value of your bond position. You calculate roughly 1/11th of that amount, or 1/9, using the 545 calculation and the nudge amount. You then sell that dollar amount of your bonds and immediately use the proceeds to buy more of your stocks or stock fund at these lower prices. You obey the rule precisely when it feels hardest, emotionally. You are using stable assets, bonds, to systematically buy potentially cheap assets, stocks, reinforcing the entire behavioral guardrail system. This is buying low mechanically. Makes sense. Example C. Let's talk taxes and allocation placement. Suppose you're in a high tax bracket and you manage both a traditional IRA, tax-deferred, and a regular taxable brokerage account.
Okay, good example. Following the rules. Your IRA, which is tax-deferred, is the ideal place to hold your taxable bonds, like corporate bond funds or treasuries, because their income won't be taxed annually within the IRA. The tax status inside the IRA is irrelevant until withdrawal. Your taxable brokerage account, however, is where you'd consider holding high-quality municipal bonds, or a muni fund, if their tax-exempt yield provides a better after-tax return for your specific high tax bracket compared to taxable bonds. You have to do the math. Now, when new contributions come in via DCA each month, they always go to whichever asset class, stocks or bonds, viewed across all your accounts combined, is currently underweight relative to the 50% target. So if stocks are 45% of your total portfolio value, IRA plus taxable combined, the new DCA money goes into stocks, regardless of which account the cash initially lands in. You might buy stocks in the IRA or the taxable account to bring the overall allocation back towards 50-50.
Right, you manage the total allocation across accounts. Okay, last one, example D, stock selection with those price guardrails. Let's say you're building that 10 to 30 individual stock basket we talked about. You've done your homework, screened for large companies with conservative balance sheets and decades of uninterrupted dividends. You've found a few candidates.
Okay, you've done the quality filter. Your final crucial filter is price discipline. You check the current valuation for each candidate. Let's say you find a fantastic company, a clear sector leader, great financials, long dividend history, but it currently trades at 35 times trailing earnings. According to the defensive rule, no more than approximately 20 times trailing earnings or 25 times multi-year average earnings, you must skip it for now. Put it on the watch list, maybe, but don't buy it today. If you screen 100 quality companies that pass your initial filters, but none of them currently meet the price discipline criteria, you accept the tactical decision required by your policy. You wait. You hold that capital in your bond sleeve. Price discipline isn't just a suggestion. It's an active form of self-control, protecting you from overpaying, which is a major source of permanent impairment. Hashtag Tech 11 common pitfalls and how to avoid them. All right, let's quickly summarize the four most predictable ways a defensive investor might undermine their own well-intentioned policy, regardless of how carefully it was written down on that one page. These are the traps to watch out for.
Okay, pitfall number 1 sounds familiar. Chasing yield.
It's the constant siren song, especially for bond investors or those nearing retirement. Viewing that bigger coupon payment on a lower quality bond as free money or easy extra income is incredibly dangerous for this strategy. That higher yield exists specifically to compensate you for taking on significantly more risk, credit risk, default risk, which fundamentally compromises the safety and stability role of your bond sleeve. If you genuinely find you need more return from your overall financial plan, the very first place to look is always increasing your savings rate, spending less, earning more through your career. Don't try to squeeze riskier returns out of the safety portion of your portfolio by resorting to weaker credit quality. That just increases the odds of permanent impairment.
Right, fix the savings rate first.
Okay.
Pitfall number 2, forecasting, trying to predict the future.
Yes, the moment you start thinking things like, interest rates are definitely going to rise soon, so I'll delay buying those intermediate bonds, or, the stock market feels way too high, it's overdue for a crash, so I'll just hold off rebalancing into stocks this time. The moment you do that, you have ceased being a defensive investor following a process and have become just another market timer making guesses. Whether you happen to be right or wrong about tomorrow's market move is completely irrelevant to the prudence of the policy today. Your job, according to the policy you wrote, is to execute the rule, not to guess the outcome. Trust the process you designed.
Okay, pitfall number 3, over-customization, getting too fancy.
Exactly. We see investors who start with the simple 50-50 structure, but then they start adding, a small cap growth fund, then an emerging markets fund, then maybe some commodities, then sector bets. Resist the urge to add too many complex rules or specialized niche funds. Keep the structure fundamentally simple. The more knobs and dials you install on your investment machine, the more opportunities you inevitably give yourself later for rationalizing deviations or finding clever excuses to override the core plan when market stress inevitably hits. Keep the structure simple enough that you can explain it clearly on that one-page policy. Add only what truly enhances the core goals without adding undue complexity or temptation.
Makes sense. Simpler is often more robust. And pitfall number 4, rebalancing drift, just not doing it.
This is perhaps the most common failure, a failure of simple execution. Failure to rebalance regularly means you are passively allowing the market's movements to set your risk profile, not your own policy. If stocks soar and your allocation drifts up to, say, 70% stocks, 30% bonds, and you fail to trim back towards 50-50, you are now exposed to 70% of the pain and the inevitable decline. You have implicitly abandoned your 50-50 anchor and taken on much more risk than your policy intended. If you suddenly realize you haven't actually rebalanced your portfolio in several years, you don't really have a policy anymore. You just have a collection of assets drifting randomly. Put those 2 rebalancing dates firmly on your calendar, set reminders, and treat them as immutable appointments with your financial future. #12 what to do next. So, if you're listening to this and you're starting from scratch, maybe feeling inspired to commit to the Defensive Investor Playbook this week, here's your concise 6-step action plan for the weekend.
Okay, step 1, sit down, maybe with a cup of coffee, and actually write your one-page policy document. Use your own words, but make sure it reflects the specific guardrails, the 50-50 anchor, the 25-75 corridor, the rebalancing rule, and the definition of risk we discussed. Commit to this document.
Step 2. Choose your specific bond and equity building blocks. Are you using index funds? Which ones? Are you picking stocks? What are your screen criteria? Decide on the actual investments.
Step 3. Log into your brokerage account and immediately set up automatic monthly contributions via dollar cost averaging. Automate it now to eliminate future decision paralysis or procrastination.
Step 4. Open your calendar right now and put 2 immovable rebalancing review dates on it for the coming year. For June 30th and December 31st. Set recurring reminders.
Step 5. Look at your account's taxable, IRA, 401k, and decide where each asset type, taxable bonds, munis, stocks, will primarily live to ensure maximum tax efficiency based on the rules we covered. Plan your asset location.
And finally, step 6, maybe the most important. Write a short note to your future self. Stick it on your monitor or inside your policy document. Something simple like, market panic plan. Follow the policy even when it feels uncomfortable. That commitment to guiding your future self is probably the most valuable step you can take today.
That's a great plan for starting fresh. What if you're an existing investor, maybe with a portfolio that looks quite different from this 50-50 structure right now?
Don't feel pressure to shift everything overnight. That can cause tax issues or trigger emotional mistakes too. The first step is just to review your current mix today. See where you actually stand relative to that 50-50 target in the 25-75 corridor. If you find you are far off, maybe you're 80% stocks or only 20% stocks, simply start nudging your allocation toward the 50-50 target in measured, proportional steps over time. Maybe use new contributions in your next couple of rebalancing cycles to gradually move closer. The goal is consistency of implementing the process going forward, not achieving immediate perfect adherence in one fell swoop. Start now, move deliberately. #outro.
Well, we hope this deep dive into the Defensive Investor Playbook has provided you with not just the theory, but also real clarity and practical, actionable steps toward achieving both safety and that crucial freedom from concern in your long-term investing strategy.
We'd love to hear from you, the listener. In the comment section, maybe tell us, what foundational investing concept should we unpack next time here at the lab? Should we do a deep dive into the power of the margin of safety concept? Or maybe analyzing owners' earnings like Buffett does? Perhaps comparing ROIC versus ROE as quality metrics? Or a detailed reflection on a company's capital allocation choices? Let us know what you'd find most useful.
And if you found this discussion useful today, please like the episode and subscribe to the channel. It really does help us keep these in-depth lessons free for everyone.
Thanks for joining.
Please remember that this content is purely for educational purposes and learning only. It does not constitute individualized investment, legal, tax, or accounting advice. You should always consult with a qualified professional before making any financial decisions based on your specific situation.